In this video, we'll look at the calculation and interpretation of two of the most popular decision-making tools in corporate finance. That's net present value and internal rate of return. First, I'll briefly give you the context as to why these are so useful in finance. And then we'll identify the key assumptions so we can be mindful of it. This key assumption in IRR that it's a single discount rate throughout the series. And that will also be an assumption if we're going to use, as we will here, the naive version or basic version of net present value where we use a single discount rate. So mindful of that assumption, it will help us to identify which project to go with when we're ranking projects and these two measures disagree. And that's a very possible outcome. We can rank projects where the net present value can tell us to favor one project, but the IRR can disagree. We'll see which one we should choose and the two specific reasons why. Finally, I'll give a simple illustration where you can also work out the answer yourself, and I'll show you how I solve for it using my calculator, the Texas Instruments BA2+. I look forward to this. Thank you. The objective here is to be able to calculate and interpret two of the most common measures that we see in finance. That's net present value and internal rate of return. They're so popular that they are also known by their acronyms, NPV and IRR. And I really do like how the CFA introduces these two measures. It introduces them in the context of their use by businesses as decision-making tools. So we could think of NPV and IRR as very popular measures used by businesses to make key financial decisions. As the CFA explains, there are three major decisions along those lines. I would say there are at least three, but these are three of the major ones. They include capital budgeting, capital structure, and decisions related to working capital management. When I first read this list, I immediately thought of the balance sheet. So this is my stylized balance sheet. By stylized, I mean it's simplified. We have on the left-hand side of the balance sheet assets, on the right-hand side liabilities plus equity. It needs to balance. Left needs to equal the right. And we sort of look at it, we generally look at it in either of two ways. As these assets and liabilities are reported or carried on the balance sheet, so that's book value, or if we're interested in economic reality, probably more likely we'll look at market values. However, they need to balance, which is to say that shareholders have, as the holders of equity, have a residual claim on the net assets of the company, such that if we take assets and subtract liabilities, what remains or what's left over or what's residual is equity. So equity is equal to the difference, assets minus liabilities. So with a simplified balance sheet like that, each of these three decisions, I think of it in terms of its position on its balance sheet. Capital budgeting is about the allocation of funds to long-range projects or investments. So that refers right here to long-term assets. Company may have lots of cash, but it needs to decide whether to allocate funds or make investments in long-term projects. Writes cash here. If it decides to do that, at the moment it makes the investment, there's really no change in the total assets of the company, but there is a conversion, a drop in cash from short-term assets to an increase in long-term assets. The asset is now in the long-term project or investment. Secondly, capital structure decisions occur over here on the right-hand side of the balance sheet, where mine is very simple in comparison to, say, a bank. A bank would have a much more complicated capital structure with several possibly different types of debt or liability, even a hybrid instrument or instruments that have characteristics of both a liability and equities. But that capital structure remains. The company needs to decide what kind of mix does it want over here on the right-hand side as the sources of funding. These are the source of funds for the assets, or these are the claim on assets. So the third is a working capital decision. We can think about that horizontally here at the top. Right, in terms of assets, it goes most liquid to less liquid. So we have short-term assets, or we could, at the very top, we have current assets and current liabilities, less than 1 year. And working capital, one definition of that could be the difference between my current assets minus my current liabilities is my working capital. So that's the third type of financial decision. So you see capital budgeting, the decision around long-term assets, capital structure, what's the mix over here, and working capital management. Three types of key financial decisions that any company makes, and these are not the only tools, NPV and IRR, but they're among the most popular tools and classic tools that a business would use to make decisions. So we have the net present value and then the NPV rule, which you'll see is a very simple rule, but net present value, a term that you've most certainly read and heard many times. Maybe, at least for me, I've heard it so many times that I just tend to gloss over it, but I would break it down into two pieces, probably, if we're really looking at it. Net present value, the first is that present value concept, right? Very important. In the previous part of the syllabus, in the previous video, in fact, we mentioned the cash additivity principle. So philosophical and profound that it's taken for granted, but that's the idea that cash flows that are indexed at the same point in time are additive, or we can add them. And we do this a lot, maybe even without even thinking about the philosophy of it. If we take a bond, for example, oftentimes we are standing here at time zero on a timeline and maybe considering the purchase of a bond that will pay coupons. I'll just represent as dollar signs, and the final return of the face value or par of the bond. And that's a stream of future cash flows. And then we will present value these cash flows, right? That stream, each stream back to time zero today. And as we do that, we've taken a stream of future cash flows and indexed them all at the same point in time, denoted T sub 0. And that cash additivity principle says we can add them. And that's, in fact, we add them when they're present valued to get the theoretical bond price. So indexing cash flows that occur at different points on the timeline to a current point in time by present valuing them is an extremely common function that we do in finance. And by the way, we don't need to index to today, right? We can index to a future point in time. As long as we index all the cash flows to that point in time, and they're on the same index on that same point in time, they're then additive. So that's the present value idea. And the other one is net. The net here means let's be comprehensive about the cash flows. Specifically, we want to include any outflows. And so when we price this bond, my bond example here, we might just take the inflows, present value them, add them up, and that would give us the theoretical bond price. But we wouldn't have included the purchase if we went ahead and purchased that bond, right? So that wouldn't be a net present value. That would just be a present value. And then so we would get some value, and maybe the traded price is pretty close to that. And then we decide, okay, let's purchase this bond. And I would represent that. It's pretty common to represent that outflow as a down arrow, right? So we purchased the bond today. It's a cash outflow. And then we're expecting a future stream of inflows. Well, when we count the outflow, now we're doing a net present value as opposed to just a present value. And this is a simple example. And in many cases, right, we would expect to have a single payment today for the instrument or for the position and then have an expectation of future cash flows. But by no means is that necessarily the only cost, right? Maybe there are some, you can imagine an instrument where we pay on installments, right? Maybe we spread out the payment over 4 payments, and maybe even the cash inflows even start before we're finished with the outflows. But the idea with the net and net present value is, if we're going to do this correctly, we need to include any outflows which are costs in the net present value calculation, or it's been incomplete. So those are the two ideas that go into that NPV term, at least from my perspective. And then we have the steps here. Identify all the cash flows, all, right? So what I'm saying is all is consistent with the term net associated with the investment. Then we need to determine the discount rate for the investment. If we're computing the NPV, we do need a discount rate, right? So that's another thing we need. It's not enough just to have the expected stream of cash flows, including any outflows. We also need to decide on a discount rate. And sometimes this is not a trivial exercise. As a consultant, I was sometimes involved in week-long projects where the company was determining what the right discount rate is to use. So this can be a non-trivial kind of exercise, but we need a discount rate to get a net present value. Then we find the present value. We sum the present values because of that cash, the validity of that cash flow additivity principle, or cash flow additivity or cash additivity principle. And then we apply the NPV rule, and we don't need to make too much fuss about that. The NPV rule is really simple here. We go ahead with the project if the net present value is positive, and we do not if it's negative. So you see the NPV rule is pretty straightforward. Okay, so in terms of the net present value and the net present value rule, here's an example of this, right? We're just summing a summation of all the cash flows, and each of those cash flows gets discounted at its rate, right, according to the relevant interval. So I'll say there's a key assumption made here as we're introducing the concept of net present value, and that is that we are using the same single discount rate throughout. You can imagine a more sophisticated version where we use different discount rates for different time horizons or maturities. Certainly we would do that if we were more sophisticated. But so we can call this a basic net present value, where I just want to highlight the fact that there is this sort of basic assumption of a single discount rate that's being used throughout. So the example here is a project where we, as a company, have the opportunity to invest $2 million. You can see time zero immediately, and then it's going to pay for what we expect then is a future stream over 3 periods of 500, 750, and then 1.35 million at the end of the third period. Now, these are period cash flows, which is to say the only thing that really matters here is that there's consistency in our discount rate and the sequence here, that these are evenly spaced. Otherwise, we haven't really said, and really would necessarily need to say, what the duration of these or what the time interval of this period is. These could be, in theory, days, although that looks unrealistic, doesn't it? But they could be months, or I'll just assume they are 1-year periods. But the key thing, if the discount rate is a period rate, and we've these periods are equally spaced, there's nothing that requires they necessarily be a year. We just need to be consistent. So we'll assume the periods are 1 year. Then, so I can apply this with the calculator, and so I'll bring over my BA Texas Instruments BA2 Plus that I tend to use, and I could do this manually, but we do have the cash flow worksheet on the calculator, so why not take advantage of it, right? I'll hit the cash flow CF, and then here my number one tip for the cash flow worksheet. And this is my number one tip only because I've made the mistake so many times of not clearing the worksheet when I start. Right, if you don't clear the worksheet, then you could have some other cash flows in there that'll get figured into it. Can't tell you how many times I've done that. So I go second, right down here is clear the worksheet. And now I have a clear worksheet. I basically have zeros everywhere. And see, I start with the first one. And so these are all in millions, but so the 3 zeros or the thousands ripple through. So I'm just going to drop off the 3,000s and know that I've done that. Right. Anytime I can save myself time, I like to do that. Right. My first cash flow is 2 million, but 2,000 on the calculator because I'm just going to be in thousands of units here. And this is going to be my outflow. So I want to make sure to make it a negative. And then now I'm going to hit enter, and I'll just point you here to the display indicator. That's that horizontal bar right above my letters and numbers here. As I hit the enter, notice the difference. Well, aside from assume my formatting, I default to 4. This little triangle is a confirmation that I entered the value. In addition to, I suppose I get the word 2, but this tells me, okay, I've got the value in. Cash flow 0. Negative 2 million is an outflow. And then I go down arrow to the first cash flow here. So that's my 500 coming back, positive or inflow. Enter, I get the triangle, I'm good. This F is, notice the C changed to F, so that's frequency. This would give me an opportunity to say that the 500 repeats a number of times. How frequent is it? It's only once here, so I'm just going to let that one remain as a default, skip it. In other words, go right to cash flow 2, which is 750. I enter that, down arrow. Its frequency is also 1, skip it, or accept the default of 1. Maybe I should say 1350. Enter, that's my third cash flow, and I am done with the cash flows. I'm going to be going for an NPV, so I can hit that now, and it knows to ask me the only thing I need to give it, right? We're computing the net present value. We need to decide on a discount rate. In this example, I've assumed 10% discount rate. I do myself have always tempted to go for the 0.1 because that would be the correct decimal format, but it's expecting the input in percentage terms here. So we hit the enter, and then so that's been accepted. And I go down arrow, and now notice I'm getting the indentation that I can actually just hit the compute, and I get the right answer, right? 88.6 is 88.6 thousand in terms of my net present value, so it works. And notice we got a positive net present value, so we can apply the rule. It's not a very fancy rule. If it's positive, we accept the project. If it's negative, we reject the project. We got a positive 88,000, so the net present value rule would tell us to accept the project. If the projects were mutually exclusive, meaning they're not independent, or we had to choose one, we would rank them and select the project with the higher positive net present value. For internal rate of return, the math really isn't different, right? Mathematically, it's still a net present value stream of cash flows. The way that I think of this is we're flipping it, it's on its head. With the net present value, we selected a discount rate, and then we solved for the net present value. IRR flips it around. The net present value is effectively the input, and the input is 0, right? We're given the assumption is a series of cash flows, and then instead of deciding on a discount rate and retrieving the net present value, we say, okay, the net, or maybe I'll put it out here, the net present value, we want to force that to be 0. And so what is the discount rate that would solve for the sum of present values to equal 0? Now that's not an analytical calculation, it's actually an iterative calculation. Even the calculator has to do a seek and find to get it. So in the definition here, I highlighted the fact that it's a single discount rate, right? Because I just want to make sure we understand that the IRR, by definition, is a discount rate that's applied to all of the cash flows in the stream. And this is relevant because when it gets to the assumption, we're going to see that by definition also, the key assumption here is that interim cash flows are in fact reinvested at that same IRR, which may or may not be realistic. Okay, so if I bring my calculator back and just show you one thing here, it really is an iteration. If I didn't have my IRR key, right, you recall we had a 10% discount rate with this series of cash flows, giving us an NPV of 88. So if I go up arrow here, if I now increase the discount rate from 10 to 11%, then my net present value should go down, right? So I'll go to 11, hit enter, and then recompute the net present value. So as I go from 10 to 11 and recompute, my net present value drops to 46,000. Okay, well then I'm going to increase the interest rate to 12%. Down arrow, net present value recompute. and I'm only 5,000. So I'm getting close such that, oh, maybe I want to go 13% for the interest rate, recompute the net present value, and now it's negative. When I went from 12 to 13, I crossed over the zero bound, right? So my IRR, I know, is somewhere between there, 12 and 13%. And we did it manually, but again, not an analytical solution. So literally even the calculator, the spreadsheet needs to do this, do a goal seek until it sets on that discount rate that solves for a zero net present value. Fortunately, I can actually just go right here to my IRR calculate. It's a keystroke, right? My cash flows are still in the calculator and hit compute, and the calculator does it very quickly. It's not difficult for the calculator. My IRR is 12.13%. This is the single discount rate that discounts these three inflows to positive 2 million, because that then adds to the negative 2 million to total zero as of the indexed value of time zero. Okay. Then the IRR rule, again, there's not a big fancy rule. It's analogous to the NPV rule. If the internal rate of return is greater than the opportunity cost, or more formally, we may call that a hurdle rate, we accept the project. If it's less than the opportunity cost or hurdle rate, we would reject the project. Now, if they are not independent, which is to say in extremis, if they are mutually exclusive, again, that means we can't, if we do one project, we have an opportunity set, multiple projects. If we do one, we might not be able to do another project, then we would accept the project with the higher internal rate of return. Okay, so problems. Well, if the projects are independent, and the definition here, I like CFA's definition, it's because it's consistent with statistical independence, which means here that if the projects are independent, that means a decision to undertake or invest in one project has no effect on our ability or our decision to invest in another project, right? The second one is independent of the first, or we could say it's not conditional on the first. Is that a realistic assumption? Well, I think it really does depend, right? We know of situations where it may or may not be realistic. I would suggest a large company with lots of resources, with respect to small projects, they are probably independent, right? Very small projects, if the company does one, it still has plenty of resource to do another. It doesn't really matter on small projects if those projects are independent. On the other hand, conversely, a small company with respect to large projects, it obviously does matter. If a small company's limited resources, if it invests in that first project, well, then that probably does impact its ability to invest in a second project. So this question of independence is relevant, and we can imagine scenarios on both sides. In which case, we could rank the projects according to NPV and IRR, and you might expect them to always give the same outcome, but it's interesting they do not. Specifically, they do not give the same answer if the size or scale of the projects differ, or they do not necessarily give the same answer if the size or scale of the projects differ, or if the timing of the project's cash flow differs. So I think these are very interesting, right? The first one here is is a difference in size. Very simple project. A and B both involve an initial outlay with an expectation of a cash flow coming back at the end of the year. The difference is that A is small and B is large. B is 3 times the investment. The IRR on A is 50%, and you can really pretty much see it visually, right? Here, we spend 10,000, expect to get back 15 at the end of the year. You can see that's plus 5 on the 10, it's 50%. Project B, however, it's 3 times the investment. We're getting back 42 plus 12. The IRR on a percentage basis is smaller. However, the net present value, and notice we do need to make an assumption, so the assumption here is 8%. Right? That's an assumption we didn't need to make with IRR because it's solving for the discount rate for us by assuming an NPV of 0. Here, the NPV on the second project is more than twice as large. That's very interesting, I think. And you can see we're putting an extra $20,000 in initially, and so we're getting we're getting 42 back as opposed to 15. So net present value dollars much larger, sensitive to the sensitive to the discount rate. The more we increase the discount rate here, the more projects B advantage here will erode relative to A. So that's an interesting difference. And then here's one in terms of timing and cash flow. Same project A above here, we invest $10,000 today, and we get back 15 at the end of 1 year, compared to, or to compete with, project D, where we also spend $10,000 today, or invest $10,000 today, but we're going to wait 3 years, and instead of getting back 15 in 1 year, we're going to get back 21,220. I don't know, at first glance, this looks like a pretty tough contest. I'm not sure I would be able to visually decide. Very interesting how different the outcomes are, right? IRR here, project A, 50% versus 28. Net present value, again, on a discount rate of 8% is very different here. Project D wins by a large margin because although we wait, we get a lot more money, or significantly more money in project D. As we increase that discount rate, this advantage here will fade. Especially here, it will fade strongly because we're waiting 3 years for that money. So what's the advice? Well, the textbook advice is to go with when they compete, as they do in both these scenarios, or when they disagree, let's say, the textbook advice is to use the NPV rule over the IRR, right? There's sort of two reasons for this. The first reason is that it's just a shareholder perspective. If we're a shareholder, what matters to us is which one has the advantage in NPV dollars, right? Put simply, we're going to be wealthier in both of these cases with the second choice, right? From a shareholder wealth perspective, NPV is more relevant to us. And the second one has to do with the assumption, the key assumption about that single discount rate in both of these measures, and that is that we are reinvesting at the same discount rate, right? So here with an IRR of 50 and 40%, these are simple examples. They don't have a series of interim cash flows, but when we have an IRR of 40%, then we're assuming interim cash flows are reinvested at that 40%. And so in that case, that's a very high number. It probably is not realistic. But with the NPV approach, remember, the 8% is an input. We decided on it. So that's going to be, almost by design, a more realistic number, right? So the fact here that interim cash flows are reinvested at the discount rate is not something that does not give us great trouble. So you see how the NPV there wins again in a contest. So the key assumption here is that both assume reinvestment at the same rate, right? Here, whatever IRR we get, we're reinvesting interim cash flows. We definitely want to pay attention to that when it's not a realistic number. And I will say that, again, I alluded to this before, this is, that's always true of the IRR. With respect to the net present value, it's just the basic flavor of net present value. There is nothing, of course, there is nothing that keeps us from discounting all of the cash flows at the same discount rate. That's just this basic version. You can imagine as we get more sophisticated, of course, we're going to vary the discount rate as we go out further on the maturity or term structure. And in most likely cases, as we go out further, we're going to increase the discount rate. So that's just a basic version of the net present value, but it is a version that many people will use, or they will stage it out, an initial stage where they use one rate, and then they shift to a second or third stage where they use a higher rate. Okay, so finally, I'll just finish with an example here, and I'll show you the problem. And one thing you can do is pause the video and then just see if you can work out the example with your calculator. And then I'll show you my answer, and I'll also show you I'll quickly do the answer with my calculator. So the problem here is Japanese company Kageyama is trying to decide whether to open a new factory to manufacture cell phone capacitors. This factory will require an initial investment of 1,000 million Japanese yen, and it will be expected to generate level cash flows of 294.8 million yen per year over the next 5 years. And the Kageyama's opportunity cost of capital, or their hurdle rate for this type of project, is 11%. So it'd be a fine time to pause the video and just see if you can work out both the net present value and the IRR. Okay, so let's see how we did. You should get, for an 11% discount rate, right? And we have a 5 years of level or constant cash flows. You should get a net present value of 89.55. I guess that's million yen. And then if you go here and compute the internal rate of return, right, basically solving for a net present value of 0, you should get an internal rate of return, an IRR of 14.5%. And directionally, they should always agree. And what I mean by that directionally is the fact that we got a positive net present value is consistent with getting an IRR that's greater than the cost of capital, right? Just as if we got a negative, NPV here, then we should get an IRR that's less than the cost of capital. So, okay, so I'll do it quickly with my calculator. And I want to remember, I hit the cash flow, and I remember my first step here is second, clear that calculator, clear that worksheet, and give it the first cash flow here. That's 1,000, but it's a negative. That's the outflow or the investment. Enter. And then I go down arrow to that first cash flow here, 294.8. Enter, down arrow. Now I get to use the frequency, right? Rather than rekey it every time, it's level for 5 periods or 5 years. So I hit the 5, enter. I like to look at the triangle, make sure I got it in. And so I'm actually done with the series of cash flows. And then I can go to my NPV, and the calculator is waiting for my discount rate. It's 11%, enter, down arrow. I'm ready to compute. 89.55, and then I go over here, and I don't need to do, my cash flows are already in. I actually can just go right to IRR, compute, 14.5%, and it works. Okay, so that's net present value and internal rate of return. And if the video is helpful, don't forget to subscribe to the channel, especially because the next video continues with discounted cash flow part 2. Thank you.